Hi friends, this is your friend Kishori Sharan. Once again, I am back. So today we are going to discuss the taxability impact on the ESOP. For the basics of the ESOP, the definition, the eligibility conditions, you can refer to my previous video which is there on my YouTube channel regarding the ESOPs. But our today's focus is on the taxability impact on the ESOPs. So taxability impact can be categorized into two categories. That is, one, the taxability in the hands of employees and taxability in the hands of employer. So we will all these impacts one by one. So firstly, just to touch base or just to give you a recap about the basic terminology is that employee stock option plan gives an employee the right but not the obligation to purchase the shares of an employee company at a predetermined exercise price that we've already discussed, right? So there are two taxable events in this particular ESOP scenario. One is when employee actually exercises the option and when employee at the time of sale of the shares. So at the time of exercise of the option, the taxable event is like it is taxable as a salary. And at the time of sale of shares, that means when employee finally sells these shares in the market or to the company basis, depending upon the circumstances, then it is taxable as a capital gains. So we will discuss all these events one by one in further details. So coming on to the next slide, in this slide, I just tried to create the taxability in the hands of employees, the basic concept, and I have categorized the whole event in four stages. The stage one is basically the stage wherein the ESOP has been granted to the employee. In this stage, there is no tax because it is only an option which is given to the employee and there is no actual allotment or sale or purchase of share has happened, right? So there is no taxability and it is not a taxable event at all. Now coming on to the stage two. Stage two is the vesting of an option. Vesting of option means employee has become only eligible, that he is eligible to take the shares of the company and hence there is no actual allotment or no actual issue of the shares has been taken place. So it is also again not a taxable event. So stage three is an important stage. Stage three is means exercise the ESOP. That means employee has finally purchased the shares of the company which has been issued to him. So this is the stage which is the first taxable event, and under this stage, tax is paid and tax is paid as per the normal slab rates of the employees because the difference is being added to the salary of employee as a perk. So I'll try to explain this concept further with the help of a numerical example that will give you better clarity. Now let's move on to the stage four. Stage four is a four wherein the finally employee sells his shares after say 2 years or 3 years when the value of the company arises. So this stage is also taxable event, and this stage tax is paid in the form of a long-term capital gain or the short-term capital gain basis the period of the holding, right? So these are the four stages primarily which describes the taxability in hands of employees. So now to give further clarity, I have just tried to create an example. So let us try to understand this example. So let us suppose there are 1,000 shares. The exercise price is 100 rupees per share, and the fair market value on the exercise date is rupees 350 per share. So let us suppose employee decided to buy the shares, right? So finally, employee pays 1 lakh rupees. 1 lakh rupees means 1,000 shares at the rate of rupees 100. So 1 lakh rupees employee pays. But however, the fair market value of those shares on the date when the employee has exercised his option to buy the shares is 350 per share. So that means in a nutshell, employee is gaining rupees 2,50,000. So 2,50,000 shall be added as a perk in the salary of the employee, and that will be taxable as a normal rates or as per the slab rates of the employee. Hence, it is being added to the salary of the employee as a perk, right? So till now, I think we are clear. Now, further extending this example, let us suppose after 2 years, employee decided to sell these shares and the sale price of these shares is 500 rupees. Now, the question here arises that how this 500 has been determined. So, this 500 has been determined basis the various methods and the fair market value of the price and the methods which are there as specified by the various laws. So, that will be discussed in further videos, but not today. So, sticking to our original example, so now employee has sold these shares at rupees 500 per share. So he's getting rupees 5 lakhs as the total consideration means 1,000 shares at the rate of rupees 500 per share. So he's getting 5 lakh rupees. And the cost of those shares is rupees 3,50,000 rupees, right? So this is rupees 3,50,000 rupees. So it means employee is gaining in a nutshell rupees 1,50,000 rupees, which in turn will be taken as a capital gain, right? So it is regarded as a capital gain. So capital gain will arise only when the employee finally sells the shares after 2 or 3 years basis his judgment. So this is the applicable for the capital gain tax. Now the question here arises is that whether it is a short-term capital gain or long-term capital gain. So that will be depending upon whether the shares are listed or unlisted and the holding period. So that you all know, listed or unlisted holding period is 12 months or 24 months. So that is basically dependent on that. So accordingly, we can calculate the capital gain tax. I hope till now it is clear. So now we are moving on to the taxability in the hands of the employee. So also there are two important aspects. First, the teaser responsibility, and second is the deduction of ESOP expense. So now, as referring to the earlier example, when employee has exercised his option and purchased the shares from the company, at that point in time, the value has been added to the salary of the employee as a perk. So on that, employer is liable to deduct the TDS as per the applicable laws and deposit to the relevant government authorities. And since first responsibility of employer is to deduct the TDS and deposit to the relevant government authorities and also report in Form 16. That is as per the normal salary TDS that we deduct in the usual circumstances, right? So this is the stage one. And now the second aspect is the deduction of ESOP expense. ESOP expense means company generally recognize ESOPs compensating employees' expense in their books basis the applicable accounting standards. In a simpler language, I should say that the ESOPs which are being issued to the employees of the company are being treated as an expense, and hence they are allowed as an expense in the books of accounts of the company, right? So there are certain you can say judgments around this also that you can refer. The latest case in this case is Biocon Limited, that you can refer and have and read it to have a better clarity, right? So these are the two primarily responsibility of employer in respect of taxation. So the key takeaways from our today's discussion is that, like at the time of grant of ESOPs, there is no tax. At the time of vesting, there is no tax. However, when employee exercises the option, then employee pays the tax, that is fair market value minus exercise price, as a salary perk, and employer deducts TDS on them, right? And when employee finally sell those shares, then employee pays the capital gain tax using fair market value as an exercise price at the cost of acquisition. An employer can generally claim the deduction for eligible ESOP compensating expense, and also employer is liable to pay the TDS which he deducts on the amount which has been added to the salary as a perk, right? And hence it is a very simpler concept, and like there's no, you can say, complexity involved in it. So I hope this is clear and I'm adding value to your professional journey. However, if you like this video, so I would request you please like, subscribe, and share my video and stay updated for a better relevant content. Thanks again for watching my video. Thank you. Thanks again, guys. Thanks.